Our key theme for this year has been strengthening portfolio resilience, an acknowledgement of the fact that we come off a couple of years of really good gains for risk assets. But we thought volatility was going to pick up through this year. We actually discussed that last time I was on the show. And when we think about the evolution of the tail risks, and obviously the profile of those tail risks is not quite what we expected at the start of the year, but the tail risks really, whether that be recession risks or inflation risks, they are just as important when thinking about the outlook for risk assets as the base case of sort of trend-like growth. And I think when we think about, advising our clients, we do think that there are specific assets to put in the portfolio for the regime that we're in at the moment. A lot of this is around diversification, a lot of it is around staying power, but when we think about starting with a 60-40 stock bond portfolio, which many thought, was dead, we still think it's a really good starting point. You've got to add in uncorrelated returns.
There's a lot to digest there. Why are historic volatility indicators in a very normal range when we are in abnormal times? I think the VIX we mentioned earlier on was around about 21. It's elevated from its historical levels, but it's not crazy levels. Why do we think people aren't taking up as much portfolio protection?
Yes, we've come off the back of 2 years in equity markets of exceptionally low volatility, single digits on the VIX, which is more abnormal. We had more rate volatility obviously last year, over the last couple of years, but equity volatility still exceptionally low. So monetizing that volatility using structured notes, structured products has been a key way that clients actually can more elegantly get into equity markets for this conversation, and we've seen huge growth in our business on that side this year. But other things that I think are really interesting are gold. Obviously it was a standout asset in the first quarter. We still think there's upside. We're starting to see ETF retail buying coming in, central banks still a key driver, but we think that that's a very good asset to have in the portfolio, along with infrastructure, because you were mentioning in your earlier segment, yes, there's a lot of conversations around downside risk to growth, but let's not forget upside risk to inflation. Let's not forget how much income can help protect the portfolio and smooth the ride. So core infrastructure to us is also a really interesting one.
I don't know if you've ever been to a vacant beach and you sit your towel down and you sit down and you're enjoying all the space.
It sounds nice. I don't know if I have.
Someone else turns up and they put their towel right beside you. There's a whole beach and they sit right beside you. Yeah. It's that protection, it's the herding, sitting next to someone makes you feel a little bit safe. And you see it in lots of different places where that happens. You have a whole beach spread out. But it's the same in markets. You mentioned the gold trade. There's been a lot of herding in the precious metal. It went right through 3,000, yes, which was the target for a lot of analysts, and it's gone beyond, and now you're calling even more upside. Yes. We've seen it in terms of the reweighting away from US equities, where everybody felt very safe, herding into those big tech stocks, 7 of them in fact, and now we're seeing the herding into defence, we're seeing it into Europe. Doesn't that make you a little bit concerned that everybody is just going with the pack? And if the pack goes in a different direction, then you get violent behaviour the other way.
Well, I think that's the purpose of diversification, and I think the drivers behind some of those assets are slightly different. So gold I'd put in a different category. I think there's been a structural change behind the fundamentals of gold post Russia's invasion of Ukraine and the greater geopolitical risks that we've seen, even more recently. I think when it comes to the equity piece, then I would agree with you, Karen, that people are very exposed to US equities, to dollar assets overall, which again feeds back into the gold story. But I think diversification by geography, and Europe really being the primary beneficiary of that, because as we've seen US growth slow because of German fiscal stimulus, you've seen European growth forecasts upgraded, and people were just very underweight in regions that were cheap. Europe was a region that was reasonably inexpensive. So diversification can help guard against that herd-like mentality.